Good morning, everybody, and welcome to the next in our series of What They Didn't Teach You About at School. The whole idea of these sessions is about touching on those different subjects around personal finances, financial planning, wealth creation, all those different types of things. Types of things, I suppose, that are life skills or things that you need to worry about in life, but they don't necessarily teach you about at school or at uni or any of those types of things. So that's the theme for these webinars. This is the second in our series. Our last What They Didn't Teach You About at School was all about cash flow, in particular, personal cash flow and personal budgets and those types of things. You can find a recording of that webinar on our website at businessdepot.com.au. You'll also find on the website a new blog where we've listed out some of the practical budgeting tools to, I suppose, to accompany that webinar, to accompany the discussion, to give you some actual practical tips, some actual systems you can use, some software you can use to take away and apply to your own personal finances. Of course, today we're talking about superannuation, a topic that unfortunately is becoming more and more complicated despite simplification of superannuation happening about a decade ago. All this complexity has crept back into superannuation. So what we want to do today is we want to just have a discussion about super. We're going to share with you some of the complexities and provide our explanation about that, and just give you some practical things to think about with your own affairs around superannuation. Joining me today, of course, I have Megan Kelly. Megan is the head of superannuation and a director of Business Depot Financial Planning here in Brisbane. So obviously perfectly positioned to talk to us today about super. Welcome, Megan.
Thanks, John.
And of course, we have Simone. Simone's one of the directors down in our Sydney office. She's a director in both the financial planning and the accounting team. So again, another great insight around superannuation. And how people can use it within their wealth strategies. Welcome, Simone.
Thanks, John. Thanks for having me.
Now, I'll just quickly mention, we love these discussions to be an open forum for you to ask any questions that you have. So if you have anything that you would like to ask, whether it's on the topic we're talking about at that point in time, obviously it needs to be connected to superannuation, please post it ideally on the Q&A tab at the bottom of the screen. It's much easier for us to manage if you do it through the Q&A rather than the chat. But by all means, please don't hesitate to ask any questions whatsoever. We'd love to take the opportunity, I suppose, to share with you our insights on that. And if we don't have the answer, at least discuss our thoughts around it. Of course, whenever we're talking about anything which is financial planning or wealth related, we have to put up our disclaimer from a financial services and licensing perspective. Of course, there's a lot of words on there and I'm sure you will all read it and I'll test you on it later. But the really key takeaway with all of that is that obviously what we talk about today is general advice in nature, and you should always make sure you get advice specific to your own circumstances before taking what we talk about today and putting it into action. So guys, let's get into it. And I suppose the thing I've always found interesting with superannuation is that super is often the second biggest asset many of us will ever have in our lives. And yet a lot of the times we don't give superannuation a lot of attention. And I think that's partly because it is, I suppose, not understood, or maybe there is too much complication in there and we don't quite know how to go about, I suppose, improving it. And I know we've got a mixture of audience today between individual employees all the way through to business owners. So Simone, can you help us, I suppose, right at the start and just at a very basic level, let's just start it. Can you tell us about the different types of super funds that are available out there?
Sure, John. Look, there are many different types of super funds, but the main three that we'll talk about today is that we've got industry funds, we've got platforms or retail funds, and we've got self-managed super funds. So when we think about industry funds, what we're thinking about is, a low-cost option that has typically a few different investment options. I mean, some of them sort of go a bit further, but some of them have your typical kind of balanced growth, conservative type options that you can choose from. You don't necessarily have a lot of transparency. You can't necessarily go, okay, where's my money invested? Well, you might know, okay, I've got, 30% in Australian shares, for example, and 20% in international shares, but you don't necessarily know the makeup of those funds. But certainly it is a more of a low cost option. Then we've got platforms. Now, when we think about platforms, what we've got is we've got like retail type platforms and wrap platforms. Now, they are typically a little bit more expensive than your standard kind of industry fund, but it comes with a range more options as well. So you have quite a few different investment options, including direct equities, different managed funds, term deposits, really quite a wide range. And then look, we've got self-managed super funds. Now, with self-managed super funds, you have the ultimate amount of investment options, but it certainly comes with a lot more responsibility as well.
So what I'm hearing there, Simone, self-managed super fund might be that ultimate from a choice and control perspective. And it sounds like that diminishes as you get to the platform and retail funds before you then get to the industry fund. Is that right?
Yeah, except for, when we think about a wrap or a platform account, then many of them actually have quite a range of investments as well. What we find is the real differentiating factor is in a self-managed super fund, you can own property directly, whereas wrap accounts, you can't own property directly. But there's still quite a lot of investment options available. But then when you get down to that, that industry fund level, like it is low cost, and that is a good thing. But yeah, that's when the investment sort of choices decline a little bit. Yeah.
Yeah, I mean, we went through that phase, didn't we, where self-managed super funds became so popular and you had people that were pushing them probably too much. And I know I'm seeing in the last little while the number of self-managed super funds, a lot of people actually exiting self-managed super funds they probably should never have been in. And so are you seeing a trend back towards industry or platform sort of style funds?
Look, we're seeing and certainly we're seeing a bit of a trend back to platforms because, there's a lot of responsibility and time that goes into managing the compliance for a self-managed super fund, as Megan would well know, because she spends a lot of her time doing that, and that's the thing. And if you don't need one, we're sort of finding that, people have got these self-managed super funds because they want all of their money in cash or in property. But, if it's not sort of looking for that property, a lot of the time we can actually find another solution that's not so, that doesn't put all the responsibility back onto the trustees being, the client yourselves.
Yeah, I mean, I often find business owners like self-managed super funds because they can be in control of it.
That's
they
right.
might be able to put that property in there and so forth. Megan, so what, I suppose, irrespective of what type of superannuation fund do we have, what should we know as a minimum, I suppose? And, maybe share with us some of those questions that you think we could all be asking our super fund.
So I think the thing that most people misunderstand when it comes to super is that it's really just an investment vehicle, and they should be asking how it's actually invested. Obviously, with the self-managed super fund, you've got that control, so you've already taken some interest in how you're actually invested. But with your industry funds, a lot of people sign up, they start their job in their 20s and they've signed up to a fund and they didn't put any thought into the investment choices. And they haven't gone back and revisited those choices to see if it's actually what they need for them. Or, if there's been more choices offered to them since they first signed up either. The other thing, I guess, to ask in relation to your own superannuation fund is what sort of insurances you're holding in the fund. There's been quite a lot of changes with some of the super rules since the Royal Commission. There's a lot of people whose insurances that they might have held in low balance funds where their insurances have been cancelled, and people just haven't been aware of it and haven't really asked those questions. So regardless of what fund you're with right now, I'd actually suggest that, when you get off this webinar, go have a look at how you're invested and consider whether it's right for you. Yeah.
I suppose, you gave the example of someone who chose a certain type of investment class on the way in. I suppose that's also relevant if your situation is changing and you want to take less risk and you're starting to get to that retirement mode. Maybe you want to take less risk at that end as well.
Yeah, exactly. So I guess a lot of things I see is people who are young, like, in their 20s and 30s being invested in, a conservative or a balanced portfolio as a bit of a default. When they could have taken on a bit more risk and maybe been in a high growth. knowing that they can't access their super for 30 years. They want to, us to come and give some planning advice, and they're still in high growth, which is quite a difficult situation for them. Yeah, and maybe not the right.
I've got a question here from one of our attendees here, Luke. Why have so many banks moved away from financing investments in self-managed super funds? Megan, would you like to take that one on?
Yeah, I'll take that one. The real issue that came about is a lot of the limited recourse borrowing, which was for property inside self-managed super funds. The numbers didn't stack up. It wasn't a good investment, and people were getting really poor advice around it, where they were actually being put, they might be 2 years away from retirement and they've gone into an off the plan unit, and the rent couldn't pay the loans. They don't have contributions coming in anymore because they're pretty much in retirement, but they don't have that income stream ready to go, because there's no liquidity in that investment. So the banks have really tightened up their lending. And to be honest, as someone who gives advice in this area, a lot of the time when it's a residential lend, I have to tell people that the numbers don't stack up. They're 100% relying on capital growth within that investment, and it's not always a good idea. But it's also unfortunately impacted a lot of other people who might have been considered borrowing to buy their business premises, which for us tends to be where we see the numbers really work well. It is just one of those challenges.
Yeah, that's right. And that the banks are having to reassess their risk as well. And when you're looking at putting a residential property into superannuation, and it might have a 4% yield, but then in pension mode, you're having to pull out at 4% pension, the net earnings that you're getting from that super fund aren't even going to be enough to pay out that pension. So that's sort of where that other complications come in.
Yeah. Simone, Megan shared with us some of the questions we could ask of our superannuation fund. Where else can you go to get other information, or I suppose about your personal super?
Yeah, well, most superannuation funds these days have a login where you can access a lot of information, but also a really good tool is Mygov. So Mygov actually has a lot of information available. So if you log in there, you can find, you can find where your superannuation is, you can find where it's, what the balance is, you can see the contributions that you've made, and you can also see, what your total superannuation cap has been, and if you've triggered any bring forward contributions or anything like that, it's all there. It's actually really great research.
So is that really the one place to go to for, I suppose, the only holistic view of all your superannuation from a personal perspective?
If the ATO has the information, it will be in Mygov. Yeah.
Okay.
Yeah. So, and look, even when you think about potentially, okay, if I've got too many superannuation funds, you can go into Mygov and you'll see them listed there. They have a consolidation tool, that can help you easily consolidate. But, bearing in mind that you need to make sure that you know what the right fund is for you first, and then you've considered any insurance, losing insurance consequences before you make any changes like that too. Yeah.
And so is that where you go if you've got lost super? Would that show up in there as well?
No, not necessarily. There's another area that you can go for lost super. There's actually a place on the ASIC website. You can search for, you can actually put your name in and see if you've got any lost money that you can find. And people have found some, so worthwhile having a look.
Yeah.
So Megan, the big question I'm always asked is how much can I put into superannuation? And again, this doesn't matter whether it's an individual employee or whether it's a business owner. Now, I know we have concessional amounts we can put into superannuation, so concessional contributions. I know we have non-concessional amounts which are not deductible, whereas the concessional are deductible. And in a very simplistic level, if you don't mind, what are the limits on how much we can put into superannuation?
So the general limits are 25,000 for your concessional contributions and 100,000 for your non-concessional. There is also then some rules around it. So if you're under 67 now, you can contribute regardless of if you're working or not. If you're over 67, you need to meet a works test to be able to make any contributions. And that works test is 40 hours in 30 days in any 30-day period throughout that financial year. So you really have to have met that test before you even make that contribution. But 40 hours is pretty easy to do.
And so that doesn't matter whether you're a self-employed person or an individual?
Yeah, so one of the biggest changes that we had in 2017 is that regardless of whether you're self-employed or an individual, you can make concessional contributions to super. So previously, to get extra concessional contributions, you had to be self-employed or do salary sacrifice arrangements. Now anyone can come to the end of the year, top up their super and claim a tax deduction in their individual tax return.
Okay, so they're the concessional contributions, the ones that you get a tax deduction for. And so the limit at the moment you said was $25,000?
Yeah, so it's $25,000 at the moment.
And what about non-concessional?
So non-concessional is the limit's $100,000, but there's also a rule that we often refer to as the bring forward rule. And that's available for people who are under 65. And they can actually bring forward a further 2 years worth of contributions and do 300,000 in one go. And so just giving you an idea, there's a slide there as to how that works. But this rule's also got a further restriction on it. When you make non-concessional contributions, you have to be under what we call your total super balance cap. And a lot of people probably have heard the 1.6 million being thrown around. That's the current total super balance cap. So, and it's all judged on last year's balance at 30 June. So if your balance at 30 June 2020 was under the was over 1.5, but under 1.6, you can do the 100,000. And then it drops down, as you can see, to if you were below 1.4 million, you can do the full 300,000 bring forward.
So what do you think the intention is in this? Is this just to try and encourage us in our final years before we've got 1.6 in super to just top it up and get as much in there as we can?
Look, everyone's situation is different, but I know, like, for me personally, super is just so far out and there's a lot of legislative changes that happen in super. I want my excess cash to be sitting against my mortgage rather than going into an environment where I can't touch it. But as I, pay down my home loan, kids finish schooling and those sort of things, I'll be looking to top up my super. So it's a chance for you to get it in there. Obviously, sometimes people get lumpy income, so they might want to get more in at that point. The other great time to think about it is if you get an inheritance or something like that, and you're nearing retirement, that's where sometimes people get, a big lump sum of cash that they want to move into that environment.
I mean, correct me if I'm wrong, but there's nowhere safer than superannuation, is there, for your assets?
Look, it's a concessionally taxed environment. It's protected from some of the bankruptcy provisions. So the only real risk is that, they change the age that you can access it. I can't see superannuation ever being taxed even if they increase the tax rates, it's always going to be less tax rate than a company, for example.
But from an asset protection perspective, I mean, it's safer than having it in your own name, isn't it?
Yes, it is. It's safer than having it in your own name if you are an at-risk sort of person and have that sort of potential bankruptcy, as long as you're not putting it in right before an event that, like an insolvency event. Yeah.
Okay, so just to recap on the contributions, 25K concessional, which is a deductible contribution, 100K non-concessional, which is a non-deductible contribution, but you can do 3 years of the $100,000 non-concessional contribution, subject to those thresholds we had up there before as to how much you already have in super.
Yeah.
Okay, so it's already getting complicated.
It is.
What about if I miss a contribution in a year or anything like that? Is there a way to sort of catch up on it? Like, I can't afford to do it this year. Can I catch up on the next year?
Yeah, absolutely. So and I think we've got a slide on this one, John. So carry forward contributions. Yep, so great. So the rolling concessional cap, the first year this was brought in was for the 2018-19 financial year. So if you had under $500,000 in your superannuation account and you didn't max out the concessional contribution cap, that excess actually rolls forward. So it continues to roll forward. So you can accumulate this rolling carried forward cap to use at a time that's actually suitable for you. So you might have sort of a lumpy income one year, you know, like we've all had varying degrees of sort of different financial situations over the last year and a half with COVID, and it might not have been the time to top up super, but then going forward there might be a great year where you want to put that extra contribution in, claim a tax deduction and get the benefit, and then, you know, the next year it could be a year that's not so great again. But as you can see on the slide, what's really a really important thing to remember is that it continues to carry forward. So there could be one year where you've got a really big capital gain and you can make a really big contribution to offset that gain. So when you're thinking about it, you're getting a tax deduction for putting money aside, investing for your own future, and you're also reducing your tax as well.
Is there any limit on how far forward that can be rolled or carried forward?
I'm actually not 100% sure on how far it can be carried forward.
Yeah.
The main sort of issues are around making sure that you've got under $500,000 in super. Sorry, Mygov, what were you going to say?
Sorry, yes, it's only for 5 years. So if you, for example, in that table, if you didn't use the 2019 financial year catch up by 30 June 2023, it's going to drop off, and that unused amount will no longer be available.
Okay, so maybe I might just wrap a few more words around that table a little bit so everybody understands. So if your cap in 2019 is $25,000, importantly, that cap is superannuation from all sources. So your employer put in $9,500, which meant you had an unused amount of $15,500. Is that correct? Yep. So that means that $15,000 carries forward into the next year, correct?
Yeah.
So when we have another $25,000 cap, we use 9.5 again. So that's why we've then got a rolling cap carried forward of $31,000. And so it keeps on going. So in this scenario here, we had up to $81,000 that was available in the 5-year period.
Yeah, and I see this as being really useful in that year. Like if you've got an investment property or going to make a big capital gain or something big's going to happen, that's when we can, you know, really get the most out of a strategy like this. Yeah.
And I do want to emphasize that this cap is from all sources. So if your employer is already putting $25,000 into super for you, then you've got no further that you can put in as a concessional contribution. You can only then put it in as a non-concessional contribution. Doesn't give you a tax deduction, but it does move it out of your personal pocket and put it into the asset protected superannuation pocket.
Yeah, that's right.
Guys, g'day, Derek's got a great question for us. How can I find my rolling concessional cap? How do I find how much I've got available at any point in time?
That's actually a good question. So you can actually find it on Mygov. So when you log into Mygov and you look in your superannuation tab, you'll actually be able to log in and see your rolling concessional cap because it will be recorded there.
And so I assume it gets that information from the ATO, which gets it from what's lodged by your employer if you're an employed person, or by your accountant if you're a business person.
And from the superannuation funds as well.
Okay, good. Now, I can't help but notice, Megan, on this slide, in 2021, 2022, you've got a asterisk and an increased amount in the concessional contribution cap. Tell us about that.
So superannuation and all these caps are set to index. So from 1 July 2021, we're expecting all of these caps to increase. So the concessional cap, the general cap, will go from 25,000 to 27,500. And the other thing that changes on 1 July is your super guarantee from your employer is also supposed to go up from 9.5% to 10%. So
you highlighted that on there as well. That potential increase in SGC may change your calculations.
Yeah.
Now, is that legislated now, the increase to 10% super guarantee?
We're just, it is actually all out there, and it's all actually in the original legislation around how the indexation is planned out. But we are expecting the budget to confirm that that's going to go ahead or not. At this stage, we haven't got 100% confirmation that nothing's going to change in this space.
I always think it's interesting when there's an increase in the super guarantee rate, depending on how, I suppose, different salary structures are put in place. Because if you've got employees, or you are an employee, and your package is expressed as an inclusive of super package, then with that extra superannuation, you could potentially be getting an actual cut in the pay you get in your bank account every time.
It's something to discuss. If you're doing those pay discussions, it's just to talk to your employer about that and how your remuneration is actually structured. It's a tough one because, a lot of businesses are still coming out of COVID, and now they're going to have to pay their employees more, but the employees don't even see the benefit. It's just, it's a frustrating thing as an employer. But as an employee, the last thing you want is a pay cut as well.
Yeah, that's right. Yeah.
Simone, a lot of people think about super or give a bit more attention to super at year end. I know business people at least do from a tax planning perspective, but individuals, it's that opportunity if you want to get that extra deduction before 30 June. What are those year end opportunities as we approach 30 June 2021?
Yeah, so as we approach the end of the financial year, if you're a business, it's a good time to think about whether or not you've actually made that 25,000 and whether or not it's appropriate for you, and you want to, max out that contribution cap, using business funds. And the other thing is if you're a individual, you have a couple of options. As we talked about earlier, you've got salary sacrifice, which is generally something you do throughout the year. However, if you haven't done your salary sacrifice and haven't arranged it, you can make a personal tax deductible contribution, and then that can help you, reduce your tax towards the end of the year. If you do that, there's just a couple of things that you really need to take into consideration, and one of them is you have to let your fund know that you're going to claim a tax deduction, and you need to do that before you lodge your tax return. So if you're going to make a contribution, before 30th of June 2021, you need to, before you lodge your 2021 tax return in the following financial year, you need to make sure that that contribution is recorded as tax deductible and that you've received confirmation from your fund as well. Yeah.
I know there's a lot of talk about timing of when you pay amounts into superannuation and when the super fund receives it. What's the important date?
The important date is that it's received before 30th of June.
Okay,
Yeah.
so what do you recommend people? You don't want to be sending that money across to the super fund on the 30th of June, do you?
No, and it may not hit the fund by the 30th of June. So really, you kind of want to make sure that you're thinking about it now and that you have your contributions in if that's something that you're going to do. The earlier the better, but definitely, you don't want to leave it to the last week of June. You want to make sure that it's done well before then.
Yeah, and similarly, if you're a business owner and you're making that super payment for employees, even though you've got till the 28th of July to make your super guarantee payments, if you want the tax deduction in that financial year, you've got to make it before 30 June. And if you're using a clearinghouse or something like that, they can take up to 2 weeks to process it. So you actually need to make it pretty early, like you're talking mid-June.
I noticed there was a change in the terms of Xero the other day where it moved it from 2 days before to 3 days before to make sure super gets there. Just that little bit more room to move. Also want to pick up on one of your comments there about salary sacrificing as well, Simone. I mean, there's been a real change of landscape with salary sacrificing since they changed the rules and allowed individuals to get a personal tax deduction. Mm-hmm. The difference being that previously individuals had to salary sacrifice to get a tax benefit from super, as compared to being able to do a bulk payment before 30 June. Does that diminish the value of salary sacrificing super, do you think?
Look, I don't think it does. And I guess it's depending on a personal situation. So when you salary sacrifice, it's happening on automatic for you. So it's something that you don't have to think about. You've thought about it at the start of the year. You've let your payroll know. You know how much money you've got left. It's like an automatic saving that into your superannuation that will also help you save tax. So you'll save the same amount of tax. It's just that it's done on your behalf. But, if you haven't done that and then you get to the end of the year, then really, it's being able to now claim a deduction for personal contributions is fantastic, because not everybody knows what their situation is going to be throughout the year. Things might change. You just don't know. So like, it's not that salary sacrificing is no longer beneficial. It's kind of a nice way to be organized if you know, or if you've got consistent income. Whereas, if you come to the end of the financial year and you've got some extra cash and you want to pop it in there, then it's a lot easier now for employees.
Yeah, absolutely. Anything to add to that, Megan?
I think also off the back of our cash flow discussions, if you're someone who knows you lack discipline when it comes to your spending habits, the salary sacrifice is a good way to go, because it happens without you knowing, and it just is already done. Like, you don't have to save the money throughout the year. Yeah.
So Megan, I might stay with you for a second, and I'll ask both of you this question, but I'll start with you, Megan, if you don't mind. Are there any other ways to get money into superannuation other than these concessional, non-concessional contributions?
The other main way to get money into super is the small business CGT concessions. They're really complicated area, but it's just important that if you are a business owner, that you know that if you sell business assets or a business itself, that there's a potential there for you to talk to your accountant as to whether you're eligible for a small business concession and whether that's something that we should pursue. And that, again, is not about just saving tax at the time, but also if it's right for you to be tying up money into super at that point in time.
Yeah, I mean, being something we give a lot of advice on small business CGT, if you're a business owner selling your business, the idea of getting up to an extra $500,000 per person into super is a big deal, especially if you're nearing retirement and so forth. Simone, are there any other ways to get money into super?
Look, I think that the budget, is coming out very soon, and I think that the government is going to be addressing superannuation in that budget, and we need to be watching that space for other ways to get money into superannuation. Another thing to note is that, what is happening today, the government might come in and make some changes around the superannuation. Yeah. So everything we've talked about today is as it is today, and then we'll be on the lookout for, are there any changes, because we're seeing some sort of news articles talking around super, but we just don't know until we have that budget night.
Yeah, well, that's next Tuesday, isn't it? Budget. Is it Tuesday? No, the Tuesday week, I think it is, the second Tuesday of May this year. And we will be hosting a webinar around lunchtime the morning after budget, and the idea of that will be to address anything that comes up in that, including any tax implications of super contributions and changes in that regard. Now, Megan, speaking of budgets, I remember there was a budget a few years ago where there was a big announcement about superannuation, where they were capping the amount that you could have in super and still be concessionally taxed at the 15% or 0% pension rate. I know there's a lot of caps and thresholds and things in superannuation. Can you try and summarise them for us, please?
So there is a lot of caps, and they are changing as well with the indexation. But right at the moment, we have what we call a total super balance cap, which is 1.6 million. And that's all around whether you can make those extra non-concessional contributions or not. And that's looking to go up to 1.7 from 1 July 2021. And there's also a transfer balance cap. So the transfer balance cap is what caps your tax-free pensions. So, and it's also 1.6, and it's going up to 1.7. So what I mean by tax-free pension is it doesn't limit how much you've got into super. Like if you've managed to get more than 1.6 into super before you start a pension, that's fine. It just means that you can only put a proportion of your super into a tax-free pension environment. And what happens when you start that pension is it means earnings from that money that's in that pension environment within your superannuation is all tax-free. So the super fund normally is taxed at 15% on any of its income, and 10% on capital gains when it's held asset for more than 12 months. But when it's in pension environment, it's actually taxed at 0%. So it's a really great strategy for you longer term. And that's why people want to have as much in super as possible in that retirement stage. Yeah.
Yeah, okay. And what about some of these defined benefit caps and different things?
Yeah, so if you are one of the lucky people that have a defined benefit superannuation fund, so a defined benefit fund, unlike some of the other funds, is like all based off your final salary and you get a percentage of that, and regardless of what money you actually had in super, it will just continue paying and increasing by CPI. With the government changes, they capped the tax-free component of a defined benefit at the 100,000. So you could get paid a pension of 100,000 a year tax-free, and anything above that was taxed. Now that cap's going up to 106,250. So just a little bit extra that you're going to get tax-free if you're on one of those pensions.
Okay, and what about these non-concessional bring forward rules? All I'm seeing is more numbers, more caps, more thresholds, Megan.
Yeah, unfortunately, indexation is not kind to us, and it has made all these numbers no longer round. So what we normally could put in 100,000, it's going up to 110, and that means all our caps that we're looking at have got these new numbers that are more complicated. Look, it's all due to come in next year. It's just important to know that it's changing. No one expects you to know these numbers off by heart. Just know that it's changing.
Okay, good stuff. So Simone, as someone who talks to clients, I suppose, about their wealth creation strategies all the time and so forth, one of the big things with the COVID strategy and the stimulus was to allow people to take $10,000 out before 30 June last year and another 10,000 after 30 June last year. Thoughts, impact of this on people's superannuation going forward?
Look, I think that it was an interesting measure by the government, because and people really took advantage of it. Some people took advantage of it who really needed it, and some people took advantage of it that maybe they didn't necessarily need it, but their income had dropped by 20%. So they, for a short period of time, so they were eligible, so they took the money. Now, the people who didn't necessarily need it but were able to and took the money, my opinion is that they're probably more likely to be able to pop it back at another time. What concerns me, though, is that the people who took the money and they really needed it, I'm more concerned about, those people really getting that money back into superannuation, because really over the long term, it does have an impact. It's something that we need to think about, and it is over the long term, but it really still does have an impact to your long-term savings. And maybe now's not the right time to think, okay, let's get it back in there. But down the track, and certainly with the planning for the future, it really is worthwhile considering putting that money back in over time.
You've got a bit of a scenario you've pulled together here for us, Simone. Do you want to talk us through this?
Sure. So when we think about, the scenario being a 30-year-old person earning 100,000 in earning 100,000 with 85,000 in super, with taking two lots of the 10,000, what we've done is we've projected it out over the life of here we go. So we've projected it out, and you can see that, what the estimated amount in retirement is. And then when you look at, so I think on the next slide, what we've got, is when you didn't take the amount. So you can actually see by not taking the amount out, you have almost $40,000 extra in retirement. So I guess what we're sort of saying is that if you took the two lots of $10,000 out over time, what happens is that compounds and it actually turns into double the amount over the life of your superannuation.
And so what I'm hearing from you is that if you took it out, depending on your personal circumstances, probably try and get it back in, but probably try and get it back in as soon as you can as well, because of the compounding effect of having it in there for so long.
Yeah, look, the compounding effect of having it in there for so long, but we also understand that it's not the easiest thing to do. And if you had to take the money out because you needed it for cash flow purposes, it just might not be on the top of the list now, but put it in the back of your mind to have a think about in the future, because what we don't want to see is that, some cash flow issues now affect retirement income later.
Because it looks like with those thresholds and so forth and the caps that Megan was talking about, that the government's trying to increase, or at least CPI is increasing the thresholds that we can put in, but we've still got to have the money to put in, don't we? So
right.
at the end of the day,
we have to have money to put in.
Yeah, that's the biggest roadblock to putting more money into super, isn't it? What else you do with it?
Yeah.
Okay, guys, hopefully that has ticked off on some of the core things around superannuation. Hopefully we've demystified some of the caps and thresholds for you. Obviously, re-emphasize our disclaimer at the beginning. Make sure you get advice specific to your circumstances, and what we've talked about today is general in nature. Have you got any parting words of advice on the topic of superannuation? Megan, I might start with you.
Yeah, look, I think the biggest thing is don't ignore it. It is a huge amount of your money. Like 10% of your overall earnings is going into super from next year. That's a lot of money to just be letting sit there and not really focused on and making it work for you. But also just try and understand it is complicated, but there is ways to get some of this information quite simply. And also just try and start to learn about what your personal circumstance is and what you can be doing for you. Don't listen to what everyone else is doing, because they might be in a very different situation to you.
Simone, final words of advice?
Yeah, look, what I would say is what you want to start by going back to what we said, really understanding, having a look on Mygov, understanding what your superannuation is all about. Learn the fundamentals, see where your funds are invested, and really once get to know your personal situation and understand where your superannuation is. And that way, when you go forward and you look at all of the complexity, you'll at least know where to start from, and that's really important.
Now, my piece of advice is to surround yourself with experts. And that's why whenever I have someone that wants to talk to me about superannuation, I make sure I've got one of these ladies on the call or in the room with me, because it is complicated, but I have also seen some very amazing results for people being able to bulk up their superannuation or buy their business premises or whatever it is they're looking at doing. So just make sure you're getting that expert advice, because you don't want to get it wrong. Consequences can be dire if you get it wrong. But getting it right can be absolutely a huge benefit to your overall wealth strategy as well. Ladies, thank you very much for your time. Thank you for everybody that's joined us on the webinar today. A recording of the webinar will be made available. I think it'll be emailed out to you, but it'll also be made available on our website at businessdepot.com.au. Simply go to the blog page of the website. You'll see a little button up the top. If you press on financial planning, you'll see all the content that's specific to financial planning, including the recording from this video, the recording of the last webinar, and also the blog I mentioned earlier around budgeting tools for your personal cash flow. Next up, in what they didn't teach you at school, I think we're talking about insurances. So I might be corrected on that, but I think we're going to talk about insurance. We're going to have Mitch Hood from our Brisbane financial planning team back on the webinar, and we'll be talking about life, TPD, income protection, and all that really cool stuff. Guys, thank you very much.
Thanks, everyone.
Thanks, everyone.